I've lived through 12 to 15 major market crashes over my lifetime. The dot-com bust in 2000, the financial crisis in 2008, the COVID crashed in 2020, and many others before those. After every single crash, people ask me the same question. How did you make money when everyone else was losing their shirts? And here's a number that surprises them. I didn't actually make money during the crashes. I made money because I owned the right assets going into the crashes. Those assets protected me. They let me not just survive, but thrive. Here's a universal truth about markets that never changes. Crashes are inevitable. You cannot predict them with precision. You cannot time them perfectly, but you can prepare for them. And preparation is what separates those who get destroyed from those who get wealthy. Think of it like a medieval fortress. When you know invaders are coming, you don't wait until you see them on the horizon to start building walls. You build the fortress in peacetime. You stock provisions. You prepare defenses. You train your soldiers. Then when the attack comes, you're ready. While others are scrambling and panicking, you're secure behind thick walls with plenty of supplies. Market crashes are the same. You build your financial fortress before the crash. Then when chaos arrives, you're protected. You can think clearly while others panic. You can act while others freeze. Most people believe the way to survive crashes is to get out before they happen, to sell everything and hide in cash, to try to time the market perfectly. I'm going to challenge that belief directly. You don't survive crashes by predicting them or avoiding them. You survive crashes by being prepared for them with the right assets. And if you're properly prepared, crashes become opportunities instead of disasters. I'm going to share with you the exact 4 asset types that have protected me through every major crash of my lifetime. These aren't secret. They're not complicated, but very few people actually implement them properly. Because here's the promise. If you build your fortress with these 4 assets before the next crash, you won't just survive it. You'll have the opportunity to build substantial wealth while everyone else is losing theirs. Let me take you back to 2008, the financial crisis, the worst economic collapse since the Great Depression. Lehman Brothers had just filed for bankruptcy. The entire financial system was in free fall. Banks were failing. Credit markets were frozen. The stock market was crashing day after day. People were terrified. I remember watching CNBC and seeing absolute panic. Seasoned investors with decades of experience were frozen. They didn't know what to do. Sell everything? Hold on? Buy more? The fear was paralyzing. Going into that crisis, Berkshire Hathaway had approximately $40 billion in cash and short-term securities. People have been criticizing us for months. You're losing money to inflation. They said you're being too conservative. You're missing opportunities. But we also held high-quality businesses, Coca-Cola, American Express, Wells Fargo, companies with strong competitive advantages and reliable cash flows, plus our wholly owned operating businesses, Geico, See's Candies, utilities, manufacturing companies. We had bonds for stability. We had real assets, railroads, energy infrastructure, manufacturing plants with real equipment, producing real products. When the market fell 50% from peak to trough, our portfolio dropped too, but it fell less than the overall market because of the balance we'd built. More importantly, we had that $40 billion in cash while everyone else was desperate, scrambling for liquidity, forced to sell at terrible prices. We could act. I made deals that seemed crazy at the time. I invested $5 billion in Goldman Sachs, $3 billion in General Electric. These were household names trading like they might not survive. But I knew they would survive. I knew the businesses were fundamentally sound. And because we had cash when they desperately needed it, we got extraordinary terms. Those investments made billions of dollars. Not because I'm a genius, not because I predicted the crisis, because I was prepared with the right assets before the crisis hit. The cash gave us the ability to act. The high-quality businesses gave us stability. The bonds cushioned the fall. The real assets kept operating and generating cash flow. That's what I mean by a fortress. That's what proper preparation looks like. The first asset in your fortress, and the most important, cash. I know what you're thinking. Cash doesn't grow. Inflation eats away at it. In normal times, holding substantial cash means giving up returns. All of that is true. But here's the reframe. Cash is not an investment. Cash is ammunition. Cash is optionality. Cash is the ability to act when opportunities arise. In a crash, when the market is down 30, 40, 50%, great businesses go on sale. You can buy $1 worth of value for 50 cents. But you can only take advantage of these opportunities if you have cash. If you're fully invested, you just watch these opportunities pass by. Stocks are cheap. You should be buying, but you have no ammunition, no dry powder. You're stuck on the sidelines. And let me tell you, that's one of the worst feelings in investing. Watching incredible opportunities slip away because you're fully committed. Because you didn't prepare. The mechanism is straightforward. Cash loses value slowly in normal times through inflation. But in crashes, cash gains enormous purchasing power. When stocks fall 50%, your cash can suddenly buy twice as much as it could before. That's not losing money. That's waiting for the right opportunity. That's patience being rewarded. Without cash reserves, you're at the mercy of markets. You cannot be greedy when others are fearful because you have nothing to be greedy with. You're forced to sell when you should be buying or at least holding. Here's my specific practice. Berkshire always keeps substantial cash. The amount varies, but we've held anywhere from $20 billion to $150 billion in cash and equivalents over the years. People constantly tell me I'm losing money to inflation. They calculate the opportunity cost. They show me charts of what that cash could have earned if invested. But I'm not losing money. I'm waiting. I'm preparing. I'm maintaining flexibility. The payoff came in 2008 when we deployed billions at fantastic prices. It came again in 2020 during the COVID crash. It will come again in the next crash, whenever that is. The principle, cash gives you options. And options have value that can't be measured by interest rates or inflation calculations. Point number 2, the practical question of how much cash you should actually hold. This depends on several factors. Your age, your risk tolerance, your living expenses, your income stability. But I can give you general guidelines. First, the non-negotiable minimum. You need at least 6 months of living expenses in cash as an emergency fund. This is not investing cash. This is survival cash. If you lose your job, if you have a medical emergency, if something unexpected happens, you need to be able to pay your bills without selling investments at potentially terrible prices. This emergency fund should be in a savings account or money market fund. Accessible, safe, not invested in stocks or bonds that could fall when you need the money. Beyond the emergency fund, you need additional dry powder for investing. I recommend approximately 10 to 30% of your investable assets in cash, depending on market conditions. Here's the key distinction. When markets are expensive and euphoric, like they often are after long bull runs, keep more cash, maybe 25 or 30%. You're not finding good opportunities anyway. Prices are high, valuations are stretched. Cash is your protection. When markets are cheap, when there's blood in the streets, when everyone is panicking, keep less cash, maybe 10% or even less. Deploy it into opportunities. This is what cash is for. The specific metrics I watch valuation levels, sentiment indicators, the general mood of investors. When everyone is optimistic and aggressive, I raise cash. When everyone is pessimistic and scared, I deploy cash. My personal system at Berkshire, we never have a fixed percentage. It's always dynamic. Right now, we're holding over $300 billion because we can't find anything worth buying at current prices. In 2008 and 2009, we deployed cash aggressively because everything was on sale. The implementation obstacle, holding cash feels bad when markets are rising. You watch your friends make 15, 20% while you're earning 4% in treasury bills. The temptation to deploy everything is enormous. But discipline means doing what's right for the long term, not what feels good in the moment. Cash in expensive markets is not a mistake. It's preparation. The payoff, when crashes come, you're ready. You have ammunition. You can act while others cannot. That ability to act is worth far more than the opportunity cost of holding cash. Point number 3, and I'll use absolute language, never be fully invested, ever, regardless of how good the market looks. The destruction mechanism of being fully invested is simple. When crashes come, and they always come, you have no ability to respond. You're locked in. You can only watch your portfolio fall and hope it recovers. But worse, you might be forced to sell. Maybe you lose your job during the recession. Maybe you have unexpected expenses. Maybe you just can't psychologically handle the losses anymore. So you sell at exactly the wrong time. If you'd held even 10 or 15% cash, you'd have a buffer. You could meet expenses without selling. You could stay calm. You might even be able to buy more. Here's the cautionary example. I've seen countless investors get wiped out. Not because they own bad businesses, but because they were fully invested with no reserves. When markets crashed, they needed money. They had to sell. They were locked in permanent losses. The protection rule always holds some cash. In good markets, in bad markets, always. Think of it like keeping gasoline in your tank. You don't run it empty and hope you find a station. You fill up when you're at a quarter tank. The same applies to cash reserves. Don't let them run to zero. Always maintain some cushion, some flexibility, some ammunition for opportunities. The payoff is psychological as much as financial. Knowing you have cash gives you confidence. You can think clearly during crashes instead of panicking. That clear thinking leads to better decisions. Better decisions lead to better outcomes. Let me tell you about an investor I knew. Very smart person, successful in business. Had built a substantial portfolio over 20 years. In 2007, his portfolio was doing great. He was fully invested in stocks. Every dollar was working. He calculated that holding any cash was costing him returns. When 2008 hit, he watched his portfolio fall 40%. He had no cash, none. He knew stocks were getting cheap. He knew he should be buying, but he couldn't. He was fully invested. Worse, in early 2009, he lost his job. The recession had hit his industry hard. Suddenly he needed money to live on. He had no emergency fund, no cash reserves. He was forced to sell stocks at the absolute bottom, March 2009, the worst possible time. He sold approximately 30% of his portfolio to generate cash for living expenses. Those stocks he sold, if he'd held them, they would have recovered, and then some. Over the next 5 years, they quadrupled. But he missed it because he was forced to sell. Meanwhile, investors who'd held cash could buy during that period. They could take advantage of once-in-a-generation prices while he was forced to sell. It broke him psychologically. He never recovered his confidence. To this day, he's out of the market entirely, too scared to reinvest. That's the tragedy of not holding cash. You don't just miss opportunities. You can be forced into catastrophic mistakes. The second asset in your fortress, high quality businesses, not just any stocks, not things you hope will go up. High quality, wonderful businesses with durable competitive advantages. In crashes, most stocks fall. That's normal. But not all businesses are hurt equally. Great businesses often get stronger during crashes. How? By surviving while weaker competitors fail, by gaining market share, by buying assets cheaply from distressed sellers. Here's the mechanism. High-quality businesses have strong balance sheets, loyal customers, pricing power, and resilient business models. When recession hits, they keep serving customers. They keep generating cash flow. They survive. Low-quality businesses with high debt, commoditized products, and weak competitive positions often don't survive. They go bankrupt. They get acquired for pennies. Shareholders lose everything. So the type of business you own matters enormously. It's not enough to say, I own stocks. The question is, do you own wonderful businesses that will survive and thrive, or speculative companies that might disappear? Let me give you a concrete example. Coca-Cola. I bought it in 1988. Since then, we've been through approximately 5 major crashes. The tech bust, 9/11, the financial crisis, COVID, others. In every crash, Coca-Cola stock fell, sometimes significantly, 30, 40% from peak to trough. But the business was fine. People kept drinking Coke. The brand remained strong. The distribution network remained intact. The competitive moat remained wide. So I never panicked. I never sold. I knew the business would be fine, and it was. Every time the stock recovered, every time the business kept growing, over 37 years, it's been one of the best investments we've ever made. That's what high-quality businesses do. They give you confidence during chaos. You're not worried about whether they'll survive. They will. So you can hold through the storm while others panic and sell. The negative consequence of owning low-quality businesses, when crashes come, you don't know if they'll survive. The uncertainty is terrifying. So you're tempted to sell, and often those businesses actually don't survive. They go bankrupt. You lose everything. The payoff of owning high-quality businesses, confidence, survival, and long-term wealth creation. You can sleep at night. You can hold through volatility. You can let compounding work. Point number 5, let me be specific about what makes a business high quality. This is crucial because most people think they own good businesses when they actually own mediocre or poor ones. I look for 4 key characteristics. Characteristic 1, a strong competitive advantage, what I call a moat, something that protects the business from competition. A powerful brand like Coca-Cola or Apple, network effects like American Express, economies of scale, regulatory advantages, patents, something that makes it hard for competitors to take market share. Without a moat, businesses get competed down to mediocre returns. With a moat, they can maintain high returns on capital for decades. Characteristic 2, strong cash generation, real cash flow, not just accounting earnings. Cash is what sustains a business during tough times. Cash pays dividends. Cash funds growth. Cash is what matters. Some businesses show profits on paper but never generate cash because they need constant reinvestment just to stay in place. Those aren't high-quality businesses. They're treadmills. Characteristic 3, good management, smart, honest, owner-oriented leaders who treat shareholders like partners. Bad management can destroy even a great business. Good management can enhance a good business. I look for managers with integrity, intelligence, and a long-term orientation. Managers who make rational capital allocation decisions, managers who don't waste money on empire building or foolish acquisitions. Characteristic 4, products or services that people need or strongly want in all economic climates. Things people buy in good times and bad times. Toothpaste, electricity, insurance, beverages, financial services, businesses selling discretionary luxury items or things easily cut during recessions suffer more. High quality businesses sell things people continue buying even when times are tough. Why do these characteristics matter? Because they determine survival and prosperity during crashes. Businesses with moats, cash generation, good management, and resilient products make it through. Others don't. The before and after contrast, before you understand these criteria, you think any profitable company is a good business. After understanding them, you realize most companies are mediocre and only a small percentage are truly wonderful. The clear criteria give you a framework for evaluation. You can look at any business and ask, does it have a moat? Does it generate strong cash? Is management good? Are the products resilient? If yes to all 4, consider it. If not, be cautious. Point number 6, you don't need to own hundreds of businesses. You need a focused portfolio of high quality ones. I own somewhere between 5 and 15 wonderful businesses at any given time. That's enough for diversification across different industries and business models. But it's concentrated enough that I actually understand what I own. If you own 50 or 100 stocks, you don't really understand most of them. You're over-diversified to the point of ignorance. That's not protection. That's confusion. The mechanism. Each business in your portfolio should serve a purpose. Each should meet the 4 criteria I just described. Each should be something you'd be happy to own for decades. When crashes come, these businesses will fall in price. That's normal. But they'll survive. They'll keep operating. They'll keep generating cash. And eventually, they'll recover and reach new highs. That's the second pillar of your fortress. While cash gives you ammunition and flexibility, high-quality businesses give you long-term wealth creation and stability during chaos. My personal approach, I focus heavily on businesses I've owned for decades. Coca-Cola since 1988, American Express since the 1960s. These are forever holdings. I know them intimately. I trust their business models. I'm confident they'll be here in 20 years. That confidence lets me ignore short-term volatility. When the stock price falls 30%, I don't panic. I know the business is fine. In fact, I might buy more. The payoff, a portfolio of 5 to 15 wonderful businesses held for decades, will almost certainly make you wealthy. Not quickly, but surely. It's worked for 75 years. It will keep working. The third asset in your fortress, bonds. Specifically, high-quality bonds. I know bonds aren't exciting. They don't produce spectacular returns. They don't get talked about at dinner parties, but they serve a critical function in your fortress. Bonds, especially high-quality ones like you. S Treasuries provide stability. When stocks crash, bonds often go up or at least don't fall much. There's a flight to safety where money moves out of risky assets into safe ones. This cushions your portfolio. It reduces overall volatility. It gives you something that's holding steady while stocks are falling. Here's the context distinction. Young investors can tolerate volatility. If you're 25 or 35 and won't need your money for 30 years, you can ride out crashes in an all-stock portfolio. The volatility is psychologically difficult, but financially manageable. But as you get older, as you approach retirement or are in retirement, you cannot afford large drawdowns that you might not recover from. If you're 70 years old and your portfolio falls 50%, you might not have time to wait for full recovery. That's where bonds come in. They stabilize your portfolio. They reduce the magnitude of crashes. They ensure you don't suffer catastrophic losses at the wrong time in life. The mechanism: bonds have fixed payments. You know what you'll receive. During stock market chaos and uncertainty, that certainty has value. Investors pay up for that certainty, which means bond prices often rise when stock prices fall. Not always. It depends on whether the crash is deflationary or inflationary. But in typical financial panics, high-quality bonds provide ballast. Without bonds, especially as you age, you're taking unnecessary risk. Your entire portfolio moves with stock market volatility. That can lead to panic selling when stocks fall sharply and you can't handle the losses. Here are specific types. Safe bonds include U.S. Treasury bonds, highly rated corporate bonds from blue chip companies, municipal bonds from strong states and cities. Risky bonds include junk bonds, bonds from weak companies, emerging market debt. In crashes, risky bonds can fall as much as stocks, defeating the entire purpose of holding them. If you're holding bonds for stability, they must be high quality. That's non-negotiable. How much should you hold? A rough rule of thumb: your age in bonds. If you're 30, maybe 30% bonds and 70% stocks. If you're 60, maybe 60% bonds and 40% stocks. This isn't rigid. Adjust for your personal situation. But it's a reasonable starting framework. The older you are, the more you tilt towards stability and away from volatility. The payoff: bonds prevent large, unrecoverable drawdowns. They let you sleep at night during crashes. They ensure you don't make panic decisions. Let me walk through exactly how these assets worked together in 2008. Going into the financial crisis, Berkshire had approximately $40 billion in cash and short-term securities. We held high-quality businesses: Coca-Cola, American Express, Wells Fargo, Procter & Gamble, plus our wholly owned operating companies like Geico, See's Candies, and others. We had some bonds, though less than most individual investors would hold, because our operating businesses provided stability. And we had real assets. We just bought Burlington Northern Railroad. We owned utilities. We owned manufacturing plants with actual equipment producing actual products. When the market fell 50% from peak to trough, our portfolio fell too, probably 25 to 30%. Not as much as the overall market because of the balance we'd built. The bonds held up. The cash held up. The high-quality businesses fell, but not as much as weak businesses. More importantly, we didn't panic. We knew our businesses would survive. We had cash to deploy. We had stability from bonds and real assets. So while others were in full panic mode, selling everything, trying to get the cash, we were calm. We could think clearly. We could analyze opportunities. I made investments in Goldman Sachs, General Electric, Bank of America later on, Swiss Re, and others, all at prices that reflected peak fear, all on very favorable terms because we had cash when they desperately needed it. Those investments produced billions of dollars in profits, not over decades, over a few years. Goldman Sachs alone made us over $3 billion in profit. That's what happens when you're prepared, when you have the fortress built before the crash. You don't just survive, you thrive. You make your best investments when everyone else is paralyzed. The lesson: surviving crashes isn't about luck or timing. It's about having the right assets in place, being prepared, and having the courage to act when opportunities arise. The fourth asset in your fortress: real assets. things with intrinsic physical value that can't go to zero. Real assets include real estate, land, farmland, commodities, infrastructure, and productive operating businesses with tangible assets. Here's why they matter. In a complete collapse scenario, paper assets could theoretically become worthless. Stocks are just claims on future earnings. Bonds are just promises to pay. But a farm, a piece of land, a factory with equipment, those exist physically. They have foundational value. My favorite real asset is farmland. I own some farmland and I love it for several reasons. First, land remains. No matter what happens in markets or the economy, you can't destroy it. It's always there. Second, farmland produces crops. It generates income. Year after year, regardless of what the stock market is doing, the farm produces corn or wheat or soybeans. Third, people always need to eat. Even in severe recessions or depressions, food is essential. Farmland often performs relatively well during crashes because it keeps producing and people keep needing food. The mechanism, real assets provide a floor. They can fall in price, yes, but they can't go to zero because they have intrinsic utility. You can use them. You can generate income from them. They're not just paper claims. Without real assets, your entire portfolio is paper, numbers on a screen, claims that depend on the functioning of financial systems and institutions. With real assets, you have something tangible, something real. Let me give you different types. Real estate can be excellent, but with important caveats. Location matters enormously. A house in a declining city might not hold value. A property in a growing area probably will. Leverage is dangerous with real estate. 2008 showed how housing prices can fall 30 to 50% in formerly hot markets. If you're over-leveraged, you get wiped out. But with good locations and moderate or no leverage, real estate provides income through rent and stability, through tangible value. At Berkshire, we own railroads, utilities, and manufacturing companies. These businesses have massive physical infrastructure. Tracks, trains, power plants, transmission lines, factories, equipment. These assets keep operating and generating cash, even in crashes. Most individual investors can't buy whole railroads or utilities, but you can buy stocks of companies that own these assets. Utility stocks, railroad stocks, REITs that own real estate, manufacturing companies with hard assets. This gives you indirect exposure to real, productive, tangible assets, not just software companies or financial services firms that are pure paper. But businesses are grounded in physical reality. The payoff. Real assets provide foundation and comfort during extreme scenarios. They ensure you're not entirely dependent on the financial system functioning perfectly. They give you a floor that can't collapse to zero. Point number 9, you need all 4 assets working together, not just 1 or 2, all 4. This is where most people go wrong. They might hold some cash but no bonds. Or they own stocks and bonds but no real assets. Or they focus entirely on real estate and ignore businesses. But the power comes from having all 4 because they complement each other. They protect each other together. They create a balanced, crash-resilient fortress. Cash gives you flexibility and ability to seize opportunities when others can't. It's your ammunition, your optionality. High-quality businesses give you growth and long-term wealth building. They're what actually makes you rich over decades. They're the engine of wealth creation. Bonds give you stability when stocks fall. They cushion crashes. They reduce volatility and prevent catastrophic drawdowns. especially as you age. Real assets give you a foundation that can't go to zero. They provide tangible value. They're the floor beneath everything else. The mechanism in a crash, cash and bonds hold up while stocks and some real assets fall. That balance prevents total collapse of your portfolio. You don't fall as far as the overall market. Then, when stocks are cheap, you deploy cash to buy opportunities. Your high-quality businesses recover and reach new highs. Your real assets keep producing income. Your bonds stabilize, and you come out ahead. Without all four, you're vulnerable. All stocks, you fall as hard as the market and might panic. All cash, you miss long-term wealth creation. All bonds, you don't build wealth. All real assets, you might be illiquid when you need flexibility. But with all four in balance, you're protected from every angle. That's the fortress concept. Walls on all sides, multiple layers of defense, multiple ways to survive and thrive. My personal observation over 75 years, I've never seen an investor maintain lasting wealth without some version of these four assets. The specific allocations vary. The exact implementations differ. But the framework holds. The payoff, balanced protection, reduced panic, ability to think clearly and act during chaos. That's worth far more than the optimization you might achieve by going all in on one asset type. Point number 10, let me give you the step-by-step process for building your fortress, regardless of your portfolio size. The same principles work whether you have $10,000, $100,000, or $1 million. The fortress concept scales. Step 1, build your cash reserves. Start with the emergency fund. 6 months of living expenses in a savings account. This is priority 1. Non-negotiable. Before you invest anything else, build this cushion. Then add investing cash. If you have $10,000 to invest, maybe keep $2,000 in cash and invest $8,000. If you have $100,000, maybe keep $20,000 in cash. The percentage depends on market conditions, but always hold some. Expensive markets like now, keep more cash. Cheap markets like 2009, keep less, deploy more. But never zero, always some ammunition. Step 2, buy high-quality businesses. Choose 5 to 15 companies you genuinely understand, not companies you've heard of. Companies you understand, you can explain what they do, how they make money, what their competitive advantages are. Look for the 4 characteristics: moats, strong cash generation, good management, resilient products, buy at reasonable prices. Not necessarily bargain prices, but reasonable. Then hold for decades. Don't trade. Don't try to time entries and exits. Just hold wonderful businesses for the long term and let them compound. Step 3, add bonds appropriate to your age and situation. If you're young, maybe 10 to 20% in bonds. If you're older, maybe 50 to 60% or more. Use your age as a rough guide adjusted for your personal risk tolerance and income needs. Stick to high-quality bonds. S Treasuries, top-rated corporate bonds. The bonds are for stability, not yield chasing. Step 4, get real asset exposure. This is harder for small portfolios, but doable. You can buy stocks of companies with significant real assets. Utilities, railroads, REITs, industrial companies. If you can afford it, owning your home or a rental property provides direct real asset exposure. Just be careful with leverage. Don't overextend. The real estate should provide stability, not create risk. The implementation framework. Start where you are. If you're fully invested in stocks right now, Don't sell everything and rebuild from scratch. That creates taxes and disruption. Instead, over the next year, gradually build the fortress, trim some stock positions to raise cash, add bond positions, redirect new savings into the four assets in appropriate proportions. Build it methodically. The tools needed: a brokerage account, access to index funds or individual stocks, access to bond funds or individual bonds. That's it. Nothing fancy. No complex strategies. Just the four basic assets. The payoff: within 12 to 24 months, you'll have a balanced fortress. When the next crash comes, you'll be ready instead of terrified. Let me give you a recent example. The COVID crash in 2020. This was the fastest crash I've ever seen. The market fell approximately 35% in about 1 month. Absolute panic. The world was shutting down. Nobody knew what would happen. Going into that crash, we had substantial cash. We held our usual high-quality businesses. We had bonds for stability. We had real assets that kept operating. When the crash hit, I did what I always do. I had cash, so I bought stocks I liked at cheap prices. Airlines, banks, other businesses that were being panic sold but would obviously survive. I held the high-quality businesses we already owned. I didn't panic because I knew Coca-Cola would be fine, American Express would be fine. Our operating businesses would survive. Some would even benefit. Our bonds provided stability. Our real assets, railroads, utilities, manufacturing plants, kept operating and producing cash, even when the economy was shut down. Within 6 months, the market had recovered most of the losses. Within a year, it was higher than before the crash. Our investments made during the panic produced substantial returns. But here's the tragedy. Many investors panicked and sold near the bottom. Why? Because they were fully invested in stocks with no cash, no bonds, no real asset foundation. When their portfolios fell 35%, they couldn't handle it. They had no stability, no cushion, no framework for staying calm. So they sold it to protect what's left. They were locked in permanent losses. They missed the entire recovery. Many still haven't re-entered the market. They're traumatized. They lost years of compounding because they weren't prepared. That's the difference the fortress makes. Same crash, same market conditions, completely different outcomes based entirely on preparation. Point number 11, let me describe what actually happens to you emotionally and financially in a crash when you built this fortress. Crashes will still hurt. Your portfolio will still fall in value. That's unavoidable. Markets crash, assets fall, numbers go down. You can't prevent that. But here's what's different. You probably fall less than the broader market. Your bonds hold up. Your cash holds up. Your high-quality businesses fall, but not as much as weak leverage companies. Your real assets provide a floor. So maybe the market falls 50%, but your portfolio falls 30%. That difference is enormous. It's the difference between devastating losses and manageable ones. More importantly, you don't panic as much. Why? Because you know you're prepared. You have cash to deploy. You own businesses you trust. You have bonds providing stability. You have real assets that can't go to zero. That knowledge gives you confidence. You can think clearly instead of emotionally. You can make rational decisions instead of panic decisions. The mechanism, panic comes from uncertainty and lack of preparation. When you don't know if you'll be okay, when you're fully exposed with no cushion, fear takes over. You sell at the bottom to escape the pain. But when you've built the fortress, when you know you're prepared, the fear is reduced. You're still uncomfortable, but you're not panicking. You can hold steady. or even buy more. Let me contrast two investors in the same crash. Investor A, fully invested in stocks, no cash, no bonds, no real assets, portfolio falls 50%, panic, sell at the bottom, locks in permanent losses, misses recovery. Investor B has the four assets, portfolio falls 30%, uncomfortable but not panicking, has cash to buy opportunities, holds high-quality businesses knowing they'll recover, bonds cushion the fall, real assets provide foundation, stay calm, buy more, recovers fully and then some. Same market, totally different outcomes. The difference is preparation. The payoff, you survive crashes, you stay in the game, you keep compounding, and that's how you build real wealth over a lifetime. Point number 12, and mark this as deeper, the psychological element of crashes is often more important than the financial element. Crashes are emotionally terrifying. The headlines scream disaster. The news amplifies fear. Everyone around you is panicking. Your portfolio is falling every day. The uncertainty is overwhelming. Your instinctive response is panic. Sell everything. Get to safety. Protect what's left. These emotional reactions are natural. They're human nature. But they're also the worst possible investment decisions. The extended metaphor. Crashes are like storms at sea. If you've prepared your ship properly with a strong hull, good captain, adequate supplies, you can weather the storm. You stay calm, you follow your plan, you trust your preparation. But if you're in a leaky boat with no preparation, every wave feels like it might sink you. Panic takes over. You make desperate decisions that often make things worse. The fortress of four assets is like a well-prepared ship. It gives you confidence during the storm. You know you have cash. You know your businesses are strong. You know your bonds are stable. You know your real assets can't disappear. That confidence allows clear thinking instead of emotional reactions. And clear thinking is what separates successful investors from unsuccessful ones during crashes. The human nature connection, we're wired for fight or flight responses. When threatened, we want to act, to do something. In markets, that usually means selling, getting out, running away. But the paradox is that running away during crashes is often the worst choice. The best choice is usually to stay calm, hold steady, or even move toward the danger by buying more. Your fortress gives you the psychological strength to override your instincts, to stay rational when everyone else is emotional. The multi-decade observation, the biggest investment mistakes I've seen are all emotional panic selling at bottoms, greed buying at tops. Following the crowd, these are emotional failures, not analytical ones. Having a prepared fortress with a clear plan reduces emotional mistakes. You're not guessing, you're not improvising, you're following the framework you built in advance. The payoff, emotional discipline, might be the single most valuable outcome of building the fortress. The actual asset protection is important, but the psychological confidence that lets you act rationally is even more valuable. Point number 13, here's the reframe that changes everything. Crashes are not just threats. They're the best investment opportunities of your lifetime. When fear is everywhere, when panic is rampant, when great companies are trading at 50 cents on the dollar, that's when fortunes are made. Not during bull markets, during crashes. But you can only exploit these opportunities if you're prepared. If you have cash, if you're not panicking, if you have the right mindset. Let me give you a historical context. Every major crash in my lifetime created extraordinary opportunities for those who were prepared. The 1973 to 74 crash, the market fell nearly 50%. Wonderful businesses traded at single-digit price-to-earnings ratios. Investors who bought and held made multiples on their money. The 1987 crash, one-day drop of 22%, total panic. But the market recovered all losses within 2 years. Amazing opportunities. 2008, the market fell 57%. Great businesses trading like they might go bankrupt. If you bought near the bottom and held, you made 3, 4, 5 times your money. The pattern is consistent. Panic creates mispricing. Fear drives prices below value. Prepared investors recognize this and act. Then they profit enormously as markets normalize. But here's the key. You cannot take advantage of these opportunities if you're not prepared. If you're fully invested with no cash, you're stuck. If you're panicking like everyone else, you can't think clearly. If you don't have the fortress, you suffer instead of profit. Let me share a specific story. In 2008, I wrote an op-ed for the New York Times titled, "Buy American I Am." People thought I was crazy. The world seemed to be collapsing. Banks were failing. The economy was in free fall. And I was saying to buy, but I wasn't crazy. I was prepared. I had cash. I owned strong businesses. I had the fortress. So I could see the opportunity while others only saw danger. The investments I made during that period yielded billions of dollars. Not because I'm a genius, because I was prepared and had the courage to act when others were paralyzed. The principle, preparation plus courage during fear equals wealth. That's the formula. The fortress gives you the preparation. You have to have courage. Let me contrast 2 investors I knew during the 2008 crisis. Investor 1 was successful, made good money, and had built a portfolio over 15 years. But he was 95% in stocks, almost no cash. No bonds, no real assets, all equities. When the crash hit, his portfolio fell almost 50%. He couldn't sleep. He was checking prices constantly. The fear was consuming him. He had no framework for dealing with this, no preparation, no plan. In March 2009, he couldn't take it anymore. He sold everything, got out completely, went to 100% cash. He wanted the pain to stop. The market bottomed literally the week after he sold. Over the next 3 years, stocks more than doubled. He missed the entire recovery. He's still mostly in cash today, too traumatized to reinvest. He destroyed his financial future with one emotion-driven decision. Investor 2 had less money initially, but was better prepared. He held 20% cash going into the crash. He owned high-quality businesses. He understood. He had bonds for stability. He owned some real estate. When the crash hit, his portfolio fell about 30%. Painful, yes, but manageable. And he wasn't panicking because he knew he was prepared. He used his cash to buy more of his favorite businesses at incredible prices. He stayed calm. He stuck to his plan. He held his bonds. He kept collecting rent from his real estate. Over the next decade, his portfolio grew substantially. He retired comfortably. He looks back at 2008 as the best thing that happened to his financial life because he was prepared to take advantage. Same crash, 2 completely different outcomes. The difference was preparation. The fortress, point number 14, after 75 years of investing, I've learned that survival is more important than brilliance. You don't need to be the smartest investor. You don't need to find the next Amazon or Tesla. You don't need perfect timing or secret strategies. You just need to survive to stay in the game. Do not blow yourself up to avoid catastrophic mistakes. If you survive all the crashes over a lifetime, you'll almost certainly get rich. Not quickly, but surely. The compounding takes care of wealth building. Your job is just to survive long enough to let it work. The 4 assets are your survival mechanism. They're your armor, your protection, your insurance, that you won't make the fatal mistake that ends your investing journey. Let me give you examples of fatal mistakes I've seen. Using excessive leverage and getting wiped out by margin calls. Panic selling at market bottoms and missing recoveries. Going all in on speculative stocks that go to zero. Being forced to liquidate during crashes because of no cash reserves. These mistakes end investing careers. The people who make them often never recover psychologically or financially. They're out of the game permanently. The 4 assets prevent these fatal mistakes. Cash prevents forced selling. Quality businesses prevent holding things that go to zero. Bonds prevent catastrophic drawdowns. Real assets prevent total loss of value. The mechanism, wealth compounds over time. But compounding only works if you stay invested. If you blow up even once, you lose years or decades of compounding. You might never catch up. So survival is paramount. Being smart is nice. Surviving is essential. My personal reflection, I'm not the smartest investor who ever lived. There are people with higher IQs, better analytical skills, more sophisticated models. But I've survived 75 years without blowing up. That survival, that longevity, is why I'm wealthy. The principle in investing, it's not about how high you can jump. It's about not falling off the cliff. The 4 assets keep you away from the edge. Point number 15, the final point. Getting rich in investing is much more about not doing stupid things than about doing brilliant things. This is counterintuitive. People think investing success requires genius, secret knowledge, perfect timing, and finding the next big thing. But that's backwards. Real wealth comes from avoiding big mistakes, from not using leverage, from not panic selling, from not chasing fads, from not buying things you don't understand, from not being greedy at tops or fearful at bottoms. The 4 assets help you avoid these mistakes. They're a framework for prudent, sensible, sustainable wealth building. Nothing flashy, nothing exciting, just solid, boring, effective. Cash prevents forced selling and enables opportunistic buying. That's not stupid. High-quality businesses prevent owning things that go to zero. That's not stupid. Bonds prevent catastrophic losses at the wrong time in life. That's not stupid. Real assets prevent total dependence on paper assets and financial system functioning. That's not stupid. Together, they form a common sense approach that has worked for generations. It will keep working because it's based on principles, not tricks. The payoff, you build substantial wealth over decades without drama, without stress, without near-death experiences. You just steadily compound by not doing stupid things. My end-of-life reflection, as I approach the end of my career, what am I most proud of? Not being the richest person, not the best returns, not the smartest trades. I'm proud that I survived 75 years of crashes and crises without blowing up, without making catastrophic mistakes, without having to start over. I credit the 4 assets for protecting me, for giving me confidence, for allowing me to act when others couldn't. They made me billions in every crash. They'll protect you too if you build and maintain them with patience and discipline. So let me bring this all together and into a clear call to action. I've shared with you the 4 assets that have protected me through every major crash of my lifetime. Cash, high-quality businesses, bonds, and real assets. These aren't complicated. They're not secrets. Anyone can build this fortress, regardless of their portfolio size or sophistication level. But here's the certainty. Crashes will keep coming. I don't know when the next one will hit. Could be next year, could be 5 years from now. But it's coming. That's not pessimism. That's reality. That's how markets work. The uncertainty is whether you'll be prepared, whether you'll have built the fortress before the crash hits, whether you'll survive and thrive or panic and suffer. Here's the binary choice. You can build the fortress now in calm markets when you have time to think clearly and act rationally. Or you can wait, stay fully invested, hope for the best, and deal with consequences when the crash comes. The negative path consequences. If you wait, if you stay unprepared, the next crash will hurt you badly. You'll panic. You'll make emotional decisions. You'll possibly lose years of gains. You might get forced to sell at the worst time. You'll watch opportunities pass while you're paralyzed. You'll suffer psychologically and financially. The positive path benefits. If you build a fortress now, the next crash becomes an opportunity. You'll fall less than the market. You'll stay calm while others panic. You'll have cash to deploy at incredible prices. You'll hold quality businesses knowing they'll recover. You'll have stability from bonds. You'll have a foundation from real assets. And you'll look back years later, grateful you prepared. Let me give you the rapid action recap. Build cash reserves immediately. 6 months expenses minimum, 10 to 30% of investable assets. Review your stock holdings. Do you own high quality businesses or speculative hopes? Replace speculation with quality. Add bonds appropriate to your age. Use your age as a percentage guideline. Get real asset exposure through stocks of companies with tangible assets or direct property ownership if possible. Rebalance to have all four assets working together, creating your fortress. Do this in the next 3 to 6 months before the next crash. While you can think clearly, there's my credibility marker. I've made billions of dollars using this exact approach. Not once. In every major crash over 75 years. It works, it's proven, it's reliable. This is the torch passing moment. I won't see many more crashes. I'm 94 years old. But you will, if you're young, you'll see 10 or 15 more crashes. Each one is an opportunity if you're prepared. Each one is a disaster if you're not. The opportunity framing, most people see crashes as threats, as things to fear, as disasters to avoid. But I see them as the best investment opportunities of your lifetime, as massive wealth transfer events, as moments when fortunes are made. You can participate in that wealth creation, but only if you build your fortress first. Only if you have cash, quality businesses, bonds, and real assets ready before the crash hits. One day, maybe 10 or 20 or 30 years from now, you'll look back at the next crash. You'll remember that you were prepared, that you had the fortress, that you stayed calm and acted while others panicked, that you built substantial wealth during chaos. And you'll be grateful you took action today. I promise you that. Build your fortress. Be prepared. When crashes come, and they will, you'll survive and thrive. That's my legacy. That's my gift to you. The four assets that protected me through everything, they'll do the same for you. Now go build your fortress.